Does it work, and is it enough? Let's bring in Jack Hough, who is, of course, senior editor at Barron's, along with Charlie Gasparino, our senior correspondent. Hi, guys. I'm sure you've been speaking amongst yourselves about the price action today. Jack, what do you think?
Non-stop, Liz.
Non-stop.
That's all we've been talking about today.
Or were you gossiping about the Yankees, right?
Yeah. More
Could
like
be anything. Well, tell me what you think, Charlie. You know, Wall Street was on the move yesterday. Some of our traders say they were in buying a lot because they hadn't seen these prices in a while.
I'm sure some of them are buying. I still think the market's in pretty tenuous shape. You would think the bounce back would have been stronger today if this was purely a technical correction and not some sort of fundamental rethinking of stocks. And I would just point out that one of the big sort of newsletters that's making the rounds, or I guess positions that's making the rounds on trading desks right now is Ray Dalio saying there needs to be, and he's predicting a QE4. Because he thinks that what's going on,
really?
That's making the rounds, and people are talking about it because he thinks that the economy's worse than what it is, than the headline numbers, and that it's going to continue to get worse, and that the Fed's not going to take chances of a double-dip recession come next year. Which I guess that would be good for the market, but it would show that the economy, if it's true, is incredibly weak.
Hey Liz, this notion that China is going to drag us down. We've heard Donald Trump talk about that. I think it's nuts. Look, Goldman Sachs has a note out today. They remind us that exports are about 13% of GDP. China's around 1% of that. There's just not a lot of business at stake. Now, don't get me wrong. A lot of our earnings growth in recent years has come from China, but we've already seen earnings growth slow to nothing in the U.S., so that growth is gone. Goldman has recommendations out for companies with a lot of U.S. revenue exposure. They like Whole Foods, they like CarMax, they like E-Trade, 25 different names today. I think you've got people saying to themselves today that, this isn't necessarily something that's going to turn into a contagion and sink our economy.
Right. Or could it be the tipping point? That's the one thing I worry about. Listen, okay, 7% of our exports go to China. It's not the whole. It's not 97% or 93%. My point is that when you see something like this and such a major economic player, that will affect other economies that we deal with. Is that the tipping point that takes 2% growth and makes it 1% or less?
But Charlie, if we were Weebles, we certainly didn't fall down yesterday. We fell down and we bounced right back up.
We didn't bounce right back up. That close was pretty crummy yesterday.
Yes, but look at today. Now that close looks like
we should have been up 600
another
points.
Ugly day. It's not that bad. We're seeing a gain right now of 242 points for the Dow. It's certainly not going to erase all of the losses.
The futures were up 600
points.
Don't be surprised, by the way, if you see we would expect a bounce from China. This is their easing policy that set off world markets, but it happened after their close. And some of the exchange traded funds are suggesting that we're going to see a big bounce there. Macquarie Research points out if you look at the H shares, the quality blue chip shares in Hong Kong, they're going for about 6 times forward earnings. That's where they've tended to bottom out in past crises there. And on average, after those periods, if you bought at the bottom, you got on average a 19% return over the next 3 months. So don't be surprised if you see a bounce from Hong Kong shares.
Yeah, you don't want to miss an opportunity, at least, to buy things that are cheap. But is the market cheap? That's an important question that we're going to be asking a bunch of our superstar investors that are coming up right now. Everybody from Scott Black of Delphi to Ward McCarthy of Jefferies. Guys, thank you so much.